Hey, I need to talk to you about something that's been on my mind for a long time. When we were kids, our parents told us something. Our grandparents told us the same thing. Teachers reinforced it. Banks capitalized on it. The message was simple. Save your money. Be responsible. Build your nest egg. And for decades, that advice worked. People saved, built wealth, bought homes, retired comfortably. But here's the thing. That world is dead. In 2026, those old rules, they don't work anymore. And today, I'm going to tell you why I officially stopped saving money. I'm going to explain why keeping your cash in a bank account might be the biggest financial mistake of your entire life. Not tomorrow, not next year, but right now, let me paint you a picture. Maybe it's your picture. You wake up at 6 a.m., you shower, you grab your coffee. Wait, no. You skip the coffee because you're trying to save money. You drive to work. 50 hours a week, not 40. 50, your kids ask you to take them on vacation. You say, not this year, buddy. Daddy's saving money. Your wife mentions that she'd love to go out to dinner. Just the two of you. You smile and say, let's order pizza at home instead. It's cheaper. You skip the gym membership. You cut back on everything, every single thing. And you know what happens at the end of the month? You check your bank account. Maybe you have 2,000 saved. Maybe 3,000 if you really crushed it. You feel proud. You feel responsible. But then you look at the price of a house in your neighborhood. It's $450,000. 5 years ago, it was $320,000. 2 years ago, it was $385,000. You do the math in your head. At $2,000 a month, it'll take you. Pause. 225 months. That's 19 years of sacrifice. 19 years of saying no to your family. 19 years of skipping vacations and coffee and dinners out. And here's the kicker. By the time you save enough for that house, the price will have gone up another $150,000. You're running on a treadmill that keeps getting faster. You worked 50 hours a week. You sacrificed. You did everything right. And you feel like the system is punishing you for it. Am I right? I used to be you. Not used to. I am you. Back in 2024, I had about $85,000 in my savings account. I was proud of that number. It took me 8 years to accumulate, 8 years of discipline, 8 years of sacrifice. I remember sitting down with my wife and saying, honey, we're doing it. We're finally going to have a down payment on a house. But then something weird happened. Around mid-2024, I started noticing something strange. The things I could buy with my money were getting more expensive. Not because the prices went up dramatically, but because they just kept going up. In January 2024, $85,000 could get you a decent used car, a year of decent living expenses, or a 20% down payment on a house in my area. By November 2024, that same $85,000 felt lighter. It felt smaller. The purchasing power had eroded. I did the math. Inflation was eating away at my savings at about 3.5% per year. But if you factor in asset price inflation homes, cars, education, it was closer to 7%. That meant my $85,000 was losing approximately $5,950 in purchasing power every single year just by sitting in a bank account. I was being punished for being responsible. That's when it hit me. I wasn't saving money. I was losing money. Every single day, my nest egg was shrinking, and I was just watching it happen. That's when everything changed. So I started digging. I wanted to understand this trap. Why does the system want you to save? And here's what I discovered: the savings trap. You see, when you save money in a bank, you're not actually protecting your wealth. You're loaning your wealth to the bank at a microscopic interest rate. Think about it. Your bank gives you 0.5% AP on your savings account. That's it. 50 basis points. A 0.5%. Meanwhile, they take that money and lend it out at 6%, 7 to 8% interest rates on mortgages, car loans, credit cards. They're making 6, 7% while paying you 0.5% the spread. That's their profit. That's how they stay rich while you stay broke. But here's the beautiful part from their perspective. They want you to save. They need you to save. Because your savings are their capital. Your discipline is their leverage. So what do? They convince you that saving is a virtue. They make you feel good about it. Good job putting money away, they tell you. Meanwhile, your purchasing power is eroding at 3-7% per year, and they're capturing most of the upside by deploying your capital into assets. They win because you stand still. They run because you sit down. And the inflation, the rising prices, that's not an accident. That's the system working exactly as designed. Central banks print money. More money in circulation means each dollar is worth less. Asset prices rise to compensate. Real estate, stocks, commodities, they all go up. But if your money is just sitting in a bank earning 0.5%, you're getting left behind. You're being systematically extracted from. And nobody's even holding a gun to your head. You're doing it to yourself. Now, I get it. I really do. Because the biggest reason people don't invest, it's not stupidity, it's not laziness, it's fear. Specifically, the fear of losing money. That's a real fear. That's a primal fear. Your brain is wired to avoid loss. Losing 1,000 feels twice as bad as gaining 1,000 feels good. That's called loss aversion, and it's kept humans alive for thousands of years. If you bet your shelter on a risky hunt, you might lose your life. So your brain learned, play it safe. Don't take risks. Hold on to what you have. That instinct made sense when you lived in a cave. It makes no sense in 2026. Because here's what everyone in your age bracket is afraid of. What if the market crashes? What if I invest my money and it all disappears? That's the fear that keeps you frozen. But let me ask you something. What if you don't invest? What if you keep all your money in the bank, earning 0.5% while inflation runs at 4 or 5%? What happens then? You guaranteed lose 3-4% of your purchasing power every single year. That's not what if that's a certainty. Over 10 years, that's nearly 40% of your purchasing power. Gone, vanished, eroded away by the very system that convinced you saving was safe. So you have two fears. Fear 1, I might lose money if I invest in the market. Fear 2, I will definitely lose money if I don't invest. And in 2026, fear 2 is the bigger threat. It's the bigger danger. It's the silent killer that nobody talks about. Because here's the difference. If the market crashes and you panic sell, you recover. Markets recover, they always have. History shows us that. But if you sit on cash and inflation eats it away, that's permanent. That's permanent loss. There's no recovery from that. That wealth is gone forever. So the question isn't, should I invest or keep my money safe? The question is, which fear should be bigger, the fear of temporary loss or the fear of permanent loss? And if you're being honest with yourself, you know the answer. Okay, so if saving is a trap, what's the solution? The solution is a fundamental mindset shift. For the last 100 years, we've been taught to think about money in one way. I earn money, I save money, repeat. That's the formula. Get a job, save as much as you can, retire at 65, live off your savings. But that formula doesn't work anymore. Not in a world where inflation is real, where asset prices are rising, where you can't outsave the system. So I'm proposing a new formula, a new way of thinking. Instead of I earn money, I save money, repeat. Think like this. I earn money, I convert money into assets, repeat. Let me say that again, because this is the turning point. I'm not saving money, I'm converting cash into freedom. When I put one zeroed into a savings account, earning 0.5%, what am I doing? I'm losing money. But when I take that same 1,000 and invest it into an index fund that historically returns 10% per year, I'm not spending, I'm not losing, I'm buying a piece of the future. I'm buying a piece of companies that are growing. I'm buying a piece of the economy that's expanding. When you reframe it that way, suddenly it's not scary, it's not risky, it's rational. Because here's what happens when you shift your mindset. You stop asking, how can I save more money? You start asking, how can I deploy my capital more effectively? You stop thinking about deprivation. You start thinking about ownership, and that changes everything because saving is about restriction. Don't spend, don't enjoy. Suffer now, enjoy later. But owning is about multiplication. Deploy capital, let it grow, enjoy compounding. One mindset leads to slow wealth building. The other mindset leads to exponential wealth building. And the earlier you make that shift, the better. All right, let's get practical. Let's look at the numbers. Show chart 1, saver versus investor over 10 years. Imagine two people, both make the same income. Both earn $60,000 a year after taxes. Both have the discipline to save $1,000 every single month. Person A, the saver. Person A puts that $1,000 in a high-yield savings account. Let's say they get 4.5% AP. That's actually pretty good right now, after 10 years. Total contributed, $120,000. Interest earned, $29,000. Total balance, $149,000. Not bad. You've added 29, zeroed in interest. Person B, the investor. Person B takes that same 1,000 and invests it into a diversified index fund. The SP 500 historically returns about 10% per year after 10 years. Total contributed, 120,000 investment gains, 82,000. Total balance, 202,000. That's a 53,000 difference. Person B has 53,000 more than person A. And get this, they made the exact same income. They had the exact same discipline. The only difference? Where they put their money. Show chart 2, asset allocation strategy. Now, I'm not saying dump everything into stocks. That's not smart. Risk management matters. Here's what I actually recommend for most people. The balanced deployment strategy. 30% index funds, low cost, SP 500 or total market index funds. Historical return, 10% annually. Risk level, medium time commitment, none, set and forget. 30% real estate if you can qualify. This could be your primary residence, a rental property, or a real estate investment trust. Historical return, 5-7% per year plus inflation protection. Risk level, medium, high, but tangible. Time commitment varies, 20% bonds, dividends, stock stability. Lower returns, but more stable current yields, 4-5% AP. Risk level low, 20% cash emergency fund, peace of mind. Keep it liquid. This is your buffer risk level. None but inflation risk. This isn't financial advice. This is just how I think about it. But here's where it gets really interesting. Watch what happens over 30 years instead of 10, the saver after 30 years. 60,360 months interest at 4.5%, approximately 620,000. The investor after 30 years. 60,360 months, investment gains at 10% annually, approximately 1,980,000. That's 3 times as much. 3 times by just changing where the money goes. And remember, both people made exactly the same choices. Same job, same discipline, same sacrifice. The difference is that one person understood the power of who is working for you. Because that's the real secret. That's what separates wealthy people from everyone else. Most people work for money. Wealthy people make their money work for them. When you put 1,000 in a bank earning 0.5%, you're the one working. You have to earn that money. The money isn't doing anything. It's sitting there losing value. But when you invest that 1,000, the money starts working. It buys you a fractional share of hundreds of companies. Those companies earn profits. Those profits grow the value of your share. The money works while you sleep, while you're at the beach, while you're playing with your kids. That's the game changer. Think of every stock or bond you own as an invisible employee. You have 100 employees working 24/7, 365 days a year. They don't ask for vacation. They don't complain. They just work. And at the end of the year, they bring you their profits. When you buy an index fund, you're not speculating, you're not gambling, you're not trying to beat the market. You're building an army of employees. You're buying pieces of the machine that runs the entire economy. And that machine has been printing profits for 150 years. So the math is simple. 1,000 in a savings account, you work for money. 1,000 in an index fund, money works for you. And that difference, compounded over decades, is the difference between struggling until age 70 and having options by age 45 now. I need to be honest with you. Because if I just told you go invest all your money in the stock market, I'd be doing you a disservice because yes, the stock market can crash. Yes, recessions happen. Yes, there's risk involved. I'm not going to stand here and pretend otherwise. But I'm also not going to let that fear paralyze you. Let me tell you about 2008, the financial crisis. The market dropped 57%. People lost trillions. That was terrifying. That was real. That happened. But do you know who came out? Okay, the people who, 1, stayed invested. 2, kept buying during the crash. 3, didn't panic sell. By 2010, the market recovered. By 2012, it hit new highs. By 2020, it was double what it was before the crash. The people who panicked and pulled everything out, they locked in their losses. They missed the recovery. They turned a temporary loss into a permanent loss. But the people who stayed calm, who understood that crashes are normal, who kept deploying capital, they became significantly wealthier. That's the difference between short-term loss aversion and long-term wealth building. Now, if you're the type of person who will lose sleep if the market drops 20%, then maybe a full stock portfolio isn't for you. That's okay. You can adjust. Maybe you do 50% stocks and 50% bonds. Maybe you do 40-60. Maybe you hold more real estate. The point isn't to take reckless risk. The point is to take strategic risk. The real risk is not taking risk. Because here's what I want you to imagine. You're 65 years old. You just retired. You spent your whole life being safe. You kept your money in a savings account. You didn't take risks. You followed all the rules. Now you're looking at your retirement account. It has 180,000 in it. At 4.5% AP, that's about 810 per month. That's your entire retirement income. Can you live on 82010 a month in 2026, in 2035, in 2040? No, you can't. So you have to go back to work. You're 67 years old. You're tired. You're exhausted. But you have to work because the safe strategy didn't work. That's the real risk. That's the real danger. The other risk, the market crash risk, that's temporary. Markets always recover. History proves it. But the risk of reaching retirement age broke, that's permanent. There's no recovery from that. So when people ask me, but what if there's a crash? I say, what if there isn't? What if you reach 65 and realize you should have started investing 20 years ago? That second question is scarier. That's the one that keeps me up at night, and that should be the one keeping you up at night too. Let me tell you about someone, not a billionaire, not some genius trader, just a regular person. Sarah was a kindergarten teacher in Austin, Texas. She made about $45,000 a year. She had 2 kids, a mortgage, and the same financial anxiety as everyone else. Around 2015, she heard some financial advice that clicked with her. Instead of just saving money, she started investing. She opened a low-cost index fund through her 401k. She started contributing $500 a month. That's it, $500 a month, just like our earlier example. For 10 years, she did this. Most months, she didn't even check the balance. It was boring. It was automated. She wasn't a financial wizard. By 2025, her investment account was worth about $85,000. Her 401k was worth another $120,000. Now, here's the thing. She didn't earn significantly more money. She didn't get rich. She didn't start a business. She just deployed capital consistently. But that $85,000 in investments meant she had options. She could take a year off if she wanted. She could send both her kids to college without crushing debt. She could take 1 month off in the summer and travel with her family. She went from financial anxiety to financial freedom, not because she became an entrepreneur, not because she got lucky, but because she shifted her mindset from how do I save money to how do I deploy capital. And she's not alone. I know nurses who did this. I know hairdressers who did this. I know people working retail who built significant wealth just by being consistent and letting time and compound interest do the heavy lifting. That's not luck. That's just math. And that math works for you too. It's not exclusive to rich people. It's not exclusive to smart people. It's just math. The only thing separating you from Sarah is time and a decision. The decision to stop saving money and start building wealth. And that decision has to come from you. Nobody's going to force you to be rich. Nobody's going to give you permission. You have to give yourself permission. So the question is, will you let me paint a different picture for you? A future picture, it's 2035, 9 years from now. You're sitting at a restaurant with your family. Your spouse is across from you. Your kids are laughing about something silly. And the waiter brings the bill. It's 95. And you know what you do? You don't look at it. You don't calculate. You don't stress. You just pull out your card. You tip 20%. You leave. Because money isn't a source of anxiety anymore. It's just there. It's handled. Your daughter has a soccer game on Saturday. Your work calls and asks you to come in. And you know what you say? No, I'm watching my daughter's game. Because you have a choice. You have options. Your investments have grown to the point where your job is a choice, not a necessity. Your son wants to go to his dream college. It's expensive, but you know you can afford it because your investments have been growing for 9 years. You don't have to tell him, I'm sorry, we can't afford it. You can say, of course we can. Let's get you there. Your mom is getting older. She's slowing down, and you realize that next summer you want to spend a month with her. Just you, your family, and your mom. Making memories, and you do, because you have the freedom to take a month off, because your investments are generating income. Because you made a different choice back in 2026. That's not luck. That's not fantasy. That's what happens when you deploy capital strategically for 9 years. That's the American Dream 2.0. Not just surviving, not just paying bills, but actually living, actually choosing, actually being free. And it all starts with a decision you make today. But here's where this gets really powerful. And this is the part that might make you cry. It's not just about your freedom. It's about your kids. Think about your childhood. Think about your family's financial situation. Think about the stress you felt as a kid. Even if you didn't understand it intellectually, you felt the financial anxiety. Maybe your parents fought about money. Maybe you went to public school instead of your dream school because of finances. Maybe you couldn't go on certain trips. Maybe you saw your parents work jobs they hated because they had no other choice. Now I'm asking you, do you want your kids to experience the same thing? Or do you want them to start from a different place? When I was a kid, my family had nothing. We were broke, we struggled, and I watched my parents work themselves to exhaustion because they had no choice. I promised myself that my kids would never feel that anxiety, they would never feel that scarcity, and the only way to do that is to build generational wealth, to create a financial foundation that extends beyond my lifetime. That sounds complicated. It's not. It means when your kid turns 18, instead of graduating with $30,000 in student loans, they graduate with $30,000 in index fund investments, with money working for them, with freedom, it means. When your kid turns 25 and wants to start their own business, they don't have to take out a business loan. They have capital from their parents' investments. It means your kid doesn't have to work as hard as you did. Your kid gets to start from a place of strength, not weakness, and that's powerful. That changes generational destinies. Because right now, if you're not building wealth, you're essentially telling your kids, start from zero, struggle like I did, work as hard as I worked. But if you make a different choice today, if you shift from saving to investing, then you're telling your kids, I've built something for you. I've created a foundation. Now build on top of that. That's not about being rich. That's about breaking cycles. That's about rewriting family history. Every single dollar you invest today is a dollar working for your children tomorrow. Every single dollar of compound growth is a gift to your legacy. That's the real power of investing. That's why this matters. Your decision today determines not just your future. It determines your children's future and maybe your grandchildren's future. That's the weight of this moment. Look, I know this video is 27 minutes long. I know you could have spent that time on something else, but I also know this is in 2026. We are at a crossroads. On one path, you continue the old way. You save money. You watch your purchasing power erode. You tell yourself you're being responsible while the system extracts wealth from you. You reach 65 broke or barely getting by. On the other path, you make a different choice. It's not reckless. It's not gambling. It's strategic. It's intentional. You take that same discipline, the same discipline that let you save money, and you redirect it toward building wealth. You invest, you compound, you build, you give your family options. You reach 65, not just surviving, but thriving. The path is yours to choose. But here's what I know. The cost of not choosing is higher than the cost of choosing wrong. If you invest and the market crashes, you recover, you learn, you adjust. But if you don't invest, there's no recovery from that. That's permanent loss. So I'm asking you, what are you going to do? Are you going to keep saving, keep playing it safe, keep watching your wealth erode? Or are you going to make a different choice? Because 2026 is the year of awakening. It's the year people are realizing that the old rules don't work, that safety is actually the riskiest move. And if you're still watching this video, if you've made it to this point, then some part of you already knows what you need to do. You just need permission to do it. So here's your permission. Start today, not tomorrow, not next month. Today, open an index fund account, put in what you can afford, automate it, then forget about it. You don't need to be perfect. You don't need to understand every detail. You just need to start. Because the greatest wealth building tool isn't intelligence. It's not luck, it's time, and time is running out. Every single day you delay is a day your money isn't working for you. It's a day of lost compounding. So I'm telling you, you can do this. I believe in you. Not because you're special, but because the math is on your side. Because the system is stacked in favor of people who deploy capital. Because history proves this works. You just have to take the first step. So what are you waiting for? Go start your future today. I'm rooting for you.